All right, we'll get started. Welcome, one and all, to today's training, trading with moving averages. So, we'll get going. For those of you who don't know me, this is some pictures of me. Anytime during the training, if you have something to say, your mics are open. It's not 1,000 people, so you can ask questions. So, I'm retired military, living here in Germany. I sing, I barbecue, and I do different businesses to make money. So one of them happened to be trading. I've also done real estate investments. I've sold stuff on eBay. I do a lot of stuff. I'm a capable money maker. So that's an easy way to say it. And besides real estate, which I think is one of the best ways to make money, Forex trading is the best way to make money. Far as the money you have to invest and far as the effort you have to put into it. It is by far the easiest way to make money. It also, you can lose money just like in everything else. Forex, you'll lose it faster than you will in real estate, but you also can gain it faster. So that's me right there, winning a 9,000 euro check from a barbecue contest. It's me with Iron Man before the movie. Yeah. So, all right. So enough about me. Disclaimer. I always say the disclaimer because whatever I teach you is for educational purpose only. You can't sue me because you messed up something I showed you because you messed it up. All this is information. You're a grown person. Trading is risky and you can lose money. By continuing with the training, you say that you're not going to sue Mr. John. That's me. Okay, what you should know after we finish this training. You should know what a moving average is. We'll talk about some definitions. You know, I like definitions and I like rules. Types of moving averages. There's more than one. How to use moving averages or the use of moving averages. What do people use them for? And trading with moving averages will be at the end. That'll be the last portion. So what is a moving average? Moving average is a line based off price data.
Sorry, John, I can't see the PowerPoint.
You can't see the PowerPoint? Can everybody see the PowerPoint? Hold up.
No,
Oh,
I can't see it either.
oh, sorry, I got you. Okay, so let me go back. Let's go back. Let's go back. Aha. Okay, so once again, here's me. Okay, suddenly, you guys mute your mics unless you're gonna talk.
Captain.
So mute your mic unless you're gonna talk. Okay, so here's me. Like I said, that's that picture of me winning the money. That's me with some models, more models, Iron Man, in front of a big crowd. Okay, so here's a disclaimer, so make sure you read this. Once again, for educational purpose, you can't sue me if you mess up. Or take back your money if you paid something, but you didn't pay for this training, so it's free. What you should know after. What is a moving average? Types of moving averages, uses of moving averages, and how to trade finally. So, first, what is a moving average? Moving average is a line that takes the price data to smooth out all of the data into a trend line, a line that displays the current average of those prices, whether it's based off of 8 periods, 5 periods, 10 periods, however much you want to use. It's the average of all those closing prices, and the line is the trailing indicator, the trailing visual representation of those prices. It is a lagging indicator, but moving averages are used to form other indicators, such as the Bollinger Bands. Your MACD uses moving averages and other oscillators. How is it calculated? As I said, they take the closing prices over the number of periods that you put in and average those, and that displays the current point of the line. So it is a lagging indicator because until the next period closes, it will be behind. So as I said, if you had a 10 period, it's going to look back 10 periods and give you an average price or average close, and that's where your line will be, the average close. Okay, types of moving averages. There's simple moving averages, exponential moving averages, and weighted moving averages. Simple one is most people, you'll find it on TradingView, it says MA, moving average. It is formed by the simplest calculations. The however many periods divided by the closing price divided by however many periods, that's plots your average. Exponential moving averages goes a little deeper because it adds a little bit more importance to the current prices. So the averages is changed, so it'll hug price a little closer. Weighted moving averages are like exponential moving averages, just a little bit more. So price will hug the the average will hug the price closer and closer with each of these moving averages. Let me show you. Okay, so here's a daily chart for New Zealand dollar. So here is let's take it off first. Let's put a 9 period simple moving average. Okay, so that's this one. That's a 9 period simple moving average. Then we'll put an exponential moving average with the same period and a weighted moving average with the same period. So we'll change the colors. We'll make the exponential moving average red, and we'll make the weighted moving average green. And let's zoom into the price a little. And as you can see, here's the 9, just the regular simple moving average is farther away from current price, than the exponential, which is the red, and then even the weighted, which is the green, is even more close to price. So the simple moving average is farther out, gives you a lot less signals. The exponential gives you more signals, and the weighted gives you even more signals. And we'll talk about the signals as we go later on in the presentation. Okay, so those are the 3 types of moving averages that most people use. If there's another one, I don't know about it, I don't use it. Uses of moving averages. Moving averages can show your trends. You can use it to see a trend. So the most common moving averages people use to show a trend is your 200. Oh, let's take that off. Either a 200 period moving averages, where the bigger investors use the 200. Bankers, people who are controlling a lot of money, they'll use a 200 period moving average, which shows the bigger trend, the long-term trend. So there's a long-term trend. Let's put another one on. Then the one for medium-term trends, let's do 2 of them. Exponential. Okay. So medium-term trends will be indicated by your 50 period moving average. Let's make that one blue, a little thicker. So those are medium-term trends. And let's make this one green. And your short-term trends, you can use a 20. The combination of these 3 form a multiple moving average, where you can use these actually to give you signals to enter and exit the market. As you see, the 200 crossed over here, which signaled all this movement. The 50 was a little later, crossing here, but it still caught all of this and would have changed here. Your 20 is very close to price and only crossed over here, and it gave another signal here, another signal here, another signal here. So with the lower the number, the more signals you'll get using that moving average. It also identifies changes in the market sentiment, which basically says it tells you whether or not you should be buying or whether you should be selling. So if you look at your these three indicators that are here, when prices moves below your 200, you should be you could be. Let's say the trading system you use, you should be looking for sales all the way down until the price crosses again the 200. If you are using your 50, you would once again you be selling from here on until here. Now price moved across again, but it crossed again. So now you're in what we say is a range area. The moving average is flat and not pointing up or down as much. It's a range area. Those are the sentiments of the market. So now we know about all these things. How do we trade it? How do we trade with the moving average? There's a lot of systems. Just like all the trading systems in the world, no two people use the same exact thing. You might learn the exact thing, but you're always going to put your little flair into it. So there's systems with only one moving average. So if we take off the 50 and the 20, if your system was using only the 200 and to enter after a cross of the moving average, and let me show you, there's also three different type of triggers in the moving averages. There's a price crossover, which is the only thing you'll have here, a price crossover or a price bounce with the one moving average. So with one moving average, you can only get a price crossover, which is what you get here. So price crossed over here, you would be selling. Let's say you would put your trade to go after the close of that candle that crossed over, and your stop would be above that candle somewhere or above the moving average. And most people who I know trade with moving averages, they don't take off the trade until the price either crosses again the opposite direction where they've broken even. Most times they'll look for a certain ratio, 1-to-1 or 2-to-1, and then they'll go to break even. And then when price crosses back again, they're looking for another trade in the opposite direction. So you got a price crossing the moving average. That's one way. And then you'll have a price bounce. So here would be a bounce. So it came and touched the moving average and bounced down. So you would trade the entry here. And same system. You'll put it above the moving average, look for a certain ratio, 1-to-1 or 1-to-2. Go to break even at that point and hope to ride the trend all the way down. On this, so that would be two trades. This would be a third trade. So once the price crossed again and bounced, if you took this trade, once this candle closed, you would be in for a long time. So of those three trades that I just showed you, this one here you've rode the market all the way up to the top for 400 and something pips. So the one that you broke even, maybe another one where you lost, this one would make up for all of those. That's using one moving average. You also can use 2 or 3 moving averages. With 2 or 3 moving averages, now you have multiple options. You have the crossover, price crossover. You also have moving average cross. The 200 and the 50 is called the golden cross. Anytime those two cross, it's called the golden cross. So here's a golden cross here. There's a golden cross. Back over here where the 200 and the 50 crossed again, that's a golden cross. Some people only trade those golden crosses. So when the moving averages cross over, you would enter there. And as you see, that would be almost the same trade that would ride all the way up. So you can do a price cross, moving average cross, moving average bounce. And there's another trade that you can do with multiple moving averages. It's a trade when the price comes into the gap, a gap trade. I didn't put that one on there. So when price breaks your lowest moving average and comes in between the lowest and the medium one, that's a gap. So that signals another trade entry. So that will put you at trading, hitting the enter this trade here because it gapped, it went into the gap here, and then it closed above, and so you would enter here and ride it up. Same thing down. So there's price crossing the moving averages crossing right here, and the gap trade and a bounce trade. The moving averages that you choose are up to you. There's 1,000 different moving averages, 1,000 different ways you can use them. The one I like the best is this one. It's from another system I use sometimes called the Spartan Trading System. They use a 12, which is your volatility moving average, a 36, a 200, and a 633. Why they choose those, you know it as you go down in the time frames. So as you look at this one here, the orange one here is your 200. So we'll mark a line here so you see where the 200 is. The 200 is here. When we go down to a lower time frame, all these moving averages, there's no work except for Heiken Ashi, sorry. 1 second. Where's your 200? Here's your 50, 36. The 36 is here. Got to mark all of them so you'll see them when you go to the lower. There's your 36, and there's your 12. So when you go to the lower time frame, those moving averages adjust now. See, now there's your 200 where the 36 was, and each of the moving averages now have moved to the lower point. So it follows the moving averages pretty good in this system. And same thing, you're using your moving averages, looking for crossovers, price crossovers, bounces, and gap trades. It's best used, the best way I've seen to use the moving averages is with Heiken Ashi candles. Have anybody used Heiken Ashi candles before? Let me see, John, on the cross, are they still looking for a particular candle? Yes, on the cross, you're looking for a candle in the direction, in the correct direction. So if it crossed going bullish, you're looking for a bullish candle to enter. So here on the Heiken Ashi, with Heiken Ashi candles, as it smooths it out, you can see you have the prices riding along here. It's very volatile price. You go down to the 1 hour, gives you a lot more signals. And remember, all we use the moving averages for really here is for signals to enter or exit the market. So here, you had a price cross here, you could enter on the next candle and ride until price crosses again. So moving averages can be used for your trading and for your determining trends in those 3 ways. We look for the price crossover or 4 ways. The moving average crossover, a price bounce, or the gap trades. We just did the chart. As I said, there's 1,000 different ways to use moving averages. There's 1,000 different ways to trade it. There's another system called multiple moving averages. Let me show you that one really quick. As I said, these are all the different systems that I have paid for and learned. So each one of them gave me different information, and all of them I've used to add to my current system that goes from A to Z, from analysis to placing a trade to money management. And you need all three things in order to be successful. Let's see if TradingView will listen. TradingView has been not treating me nice so far today. I think every time I open up a new chart, it doesn't like me.
It's lagging for me last night as well again. So
Okay, okay. Here it goes. Okay, so here's the multiple moving averages. So as it says, it uses multiple moving averages to give you trade indications. The difference they use though is they actually turn off the candles. So here it is with the candles down here, and here how it looked without the candles. Here is a flag with just moving averages. Here it is with the candles. So it shows you the same thing, except for, as I said, it's only using the moving averages. So there's different terms for these. There's a knot, there's a swirl. Um, Once again, there's another trade where it's a bounce. It's called a bounce, where the higher moving averages, when it comes past all the other ones and crosses them, you enter there, which would have been basically a flag again. See, that's the same pattern here. The price went above all the other moving averages. When it crosses, you enter. So you'd have entered around here after that engulfing candle. So that's a system using multiple moving averages. There's another guy I know. His name is David too. He uses this. This is the only thing he does. He takes. Let's turn off. I have it on here. The 50 EMA. That's it. He uses a 50 EMA and Heiken Ashi candles. That's all he uses, and he takes a small account. He's done it before. He showed me. He takes a small account, maybe $50, $100, where you can leverage a lot in the account, and all he waits for is for price to cross that moving average and pull back. So he's looking for pullback trades. So every time down this way here, let's say he saw the price here. It crossed the moving average. When it came back here, he enters the trade. And he would stay in that trade as long as the sentiment was still bearish. When it crossed back over, he's out of the trade. But along the way, boom, enter. Boom, enter. Another cross, waits for another entries, crosses again. Yeah, he would trade it all the way down. And this is the thing, same thing with how I teach, is that once you in a trade going in a direction, you can ride that trade all the way down. You ride the wave all the way. But if you catching the trade down here in the middle of the wave, that's when you don't trade it. You only trade from the beginning of the wave to the end of the wave. Beginning of the wave to the end of the wave. So if you don't get in here on this money trade or blue zone trade, then you wait until price gives you another reason to get in. And it has to be a good damn reason. It has to be a good reason. So that is multiple moving average trading and the single 50 EMA with Heiken Ashi trading. Those are two systems that I learned also. So back to my little spiel. Many systems, one market, no holy grail, no two successful traders trading the same thing. Learn before you earn, or train before you trade. Good system. This is what a good system should allow you to do. If you're missing any of these, then you need to have it. Good system allows you to see the market through analysis, to find trading opportunities by locating high probability setups, to enter, set your targets, and protect your money. That's money management, and enter in the correct lots and everything. And to know why and why not, psychology. And that's psychology of the market and of yourself. So the market psychology is knowing the sentiment of the market. Your own psychology is that's why we have rules. We have rules in my system. You take certain number of trades, you take this amount of money, everything. There's always rules. So that rule, those rules allow you to have use the good psychology, and you don't overtrade or um, what they call a revenge trade. You don't do any of those things because you have a complete system that says if this, do this. If this, do this. If this, don't do this. You have those two. So the system has to have that. And I've already talked to Umar before. He knows I have, of course, our Wave Rider Forex system. I'm on. I don't know. I'm gonna have to start maybe calling it the Too Easy system, huh? I don't know. Too Easy system. 4 to weeks, 4 to 6 weeks of 1v1 training. You get 2 to 3 sessions each week. About 1 hour to 2 hours, depending on what all you need to go through. Lifetime training room access. We do market outlooks when we do your training, pretty much, because we go through the chart so much. Monthly training events like this. I'm doing more often because, as I said, trying to get more students right now. And we do live trading room. So during the live trading room, you get to log on just like this, and you watch me trade. You see what I do. You don't if you're been into if you know what I'm doing, you'll understand. But the 4 to 6 week training is once you've completed week 5, you can at that point really understand what we're talking about in the live room. And if you haven't completed the 5th week at least, you haven't even learned how we do trade entries. And we have I think 9 trade entries that we currently use, 8 or 9. I think it's 8. Let me look. 1, 2, 3, 4, 5, 6, 7, 8. 8 trading strategies that we use to enter the market. Complete trading strategies with systems of numbers of when to enter, where to put your stop, where your targets to be. There's no doubt, no ambiguity in anything you do. In the live trading room, you see me analyze the market and take those trades. You're welcome to take those trades, or you don't have to take them. It's up to you. On TradingView, you already know where to find me. If you have any other questions, there's my email, and you also can reach me through WhatsApp. Um, does anybody have any questions about what we just talked about in this presentation?
No, not today from me, John. Thank you.
Let's see. So probably
Thank you,
better
John.
to
Yeah,
use it.
I'm alright.
Same for me too. Okay, so I'm gonna stop the recording, and at that point, we'll be